This next review chapter is going to be covering labor and financial markets and how labor and financial markets intersect in economic terms in order to be able to uh, kind of show how supply and demand works in a world of scarcity. Because, again, with labor and with money, generally there's not an unlimited quantity. So, we're going to talk about three elements: some demand and supply at work in labor markets, supply and demand at work in financial markets, and the market system as an effective mechanism for information. So most of people think of supply and demand in relation to goods like guns or butter or gasoline or something like that. But labor markets, such as nursing, teaching, etc., can also apply to the analysis because there's a limited number of nurses, or there may be a surplus of teachers. And so as a result, almost any type of market in which there's scarcity creates an opportunity for economic law to work. So let's talk a little bit about supply and demand at work and labor markets. So the labor market is the supply and demand for labor. So it's basically any situation where you've got a worker or a type of labor or a skill and someone looking to employ that skill and a medium of exchange for which that's going to be paid. So the law of demand in labor markets is going to be the same as a law and demand for any other good or service, which is the higher salary or wage in the labor market, that decreases the quantity of labor demanded by employers. The more it costs to get somebody, the less they're going to be able to want of that. And then the lower salary or wage, the higher the increase in quantity of labor demanded. So if you can get someone to mow your lawn for $1, then you may want to get your lawn mowed every day. If it's going to cost $1,000, you may get your lawn mowed twice a year. And so again, the law of demand is going to be the lower the cost of labor, the more demanded, the higher the cost of labor, the less demanded. The law of supply in labor markets is exactly the same as the law of supply with almost any other good or service, which is the higher the price for labor, the higher the quantity of labor supplied. So again, going to our lawn mowing example, if you get $1,000 to mow a small yard, there's going to be a lot of people wanting to line up to mow those yards. If it's $1, there's going to be very few people that are going to sign up for that. And the lower the price for labor, the lower the quantity supplied. And so, like any other economic condition, the equilibrium point is the quantity supplied and the quantity demanded are equal. At the equilibrium wage, employers can find workers and workers can find jobs. And there's going to be some employers that can't find workers because they're not willing to pay enough. And there's going to be some workers who can't find jobs because they're not willing to make less than a certain floor. Here's an example. Labor market supply and demand for nurses is the demand curve. So supply, and this is a demand curve here for employers who want to hire nurses, intersects with the supply curve S of those who are qualified and willing to work at equilibrium point E. So right here, at above equilibrium salary of $90,000, which is the equilibrium salary here at $90,000, quantity supplied increases to $45,000. So you get additional supply, but the quantity of nurses demanded at the higher pay declines. So at $90,000 here, the quantity demanded declines to $40,000. At this above equilibrium salary, there's a surplus of nurses. So there's a surplus of nurses up here, and then down here, if the below equilibrium salary of $75,000 is put in place, the quantity supplied goes to $34,000 because the nurses will do something else, or some nurses will do something else, and the quantity demanded will go up to $47,000 because maybe they were using less qualified labor, but now you can get a qualified registered nurse, and so you're going to go ahead and kind of move down the equilibrium point to here. At that below equilibrium salary, excess demand or shortage of nurses exists. So in this case, you've got a shortage of nurses. In this case, you've got a excess supply of nurses. Shifts in labor demand can be caused by, here's 6 factors, by a number of factors. You've got demand for output changes, education and training changes, technology changes. The number of companies in the market changes. Government regulations can change the demand curve, and price availability of other inputs. Shifts in labor supply, so in the availability of folks like nurses, is going to include a number of workers, required education to be able to be qualified, and government policies. So, when you think about medical doctors, for instance, there's generally a shortage or perceived shortage of medical doctors because you have to go to school 4 years, then you got to go to 4 years of medical school, then you've got your residency. So it's about 12 years by the time you're out making money as a doctor, and so as a result, there's a low supply, which then creates a relatively high wage in order to be able to meet demand. Technology and wage inequality. So here's a discussion question for you to think about, and you can put in the LMS. How would new technologies affect the wages of high skill and low skill workers? And you can think about that in terms of AI, like ChatGPT or other AI tools that are kind of changing how some of these workers interact with both their jobs and the availability of information. So use a four-step process of analyzing how shifts in supply or demand impact or affect a market. Essentially, and we talked about it in the last chapters, how do those 4 steps of, kind of the increase in supply, increase in demand, the shifts in the curves then change the quantities and prices of each of those 4 elements. So applying demand and supply in technology and wages, the demand for low-skill labor shifts to the left, so essentially goes down when technology can do the job previously done by those workers. So, when we see this shift to the left, all of a sudden the equilibrium for low-skill laborers, the wages drop from W0 to W1, and the quantity demanded also drops from Q0 to Q1. So now you've got more unemployment, and those that are remaining employed are at lower wages because technologies displace those jobs. New technologies can also increase the demand for high-skill labor in fields such as information technology and network administration, because the technology that displaced these workers creates jobs for these workers. And so as a result, you see a shift in the demand curve to the right for high-skilled labor, and you end up having both quantity demanded and wages going up. So in a lot of ways, when you hear about technology displacing, it's really a question of the timing of how that impacts people and jobs, because it can be incredibly disruptive to a particularly local labor market when you have, for instance, a manufacturing plant go from manual work to robotics, lay off all these low-skilled laborers. But what those robotics do is create manufacturing jobs to build the robots. They create maintenance jobs to support the robots. And so as a result, there's a need to essentially, and again, it's not as simple as I'm making it out to be, but to retrain that worker base to go from the types of jobs that have been lost to the jobs that have been created as part of that technology shift. And what you'll tend to see if you look at economic history, is some of our most troubled times, and of which I would start, kind of classify where we're at today, have been when there's been significant shifts in technology, which displace a number of workers, which creates angst and anxiety with those workers, and as a result, you tend to see social unrest because those workers are displaced. So when you see long periods of social stability, let's call it the 30s, late 30s through the early 70s in the United States, where wages are rising, and could theoretically, although not practically, kind of viewed with nostalgia today as kind of an economic boom time for the middle class, etc. You had relative stability in technology. Then you had a very rapid shift when the price of computing came down in the 70s. The advent of the personal computer changed a lot of white-collar, low-skilled white-collar workers like secretaries, telephone operators, etc. Those all became automated. You saw wages fall. You saw disruption in the 80s, around 70s and 80s. You saw economic turmoil, high inflation, high unemployment. A lot of took about a decade, and that kind of transitioned over to where we saw another growth period where you had technological changes, but it was largely building on that same theme from the 80s through the 90s into the early 2000s. Then you saw the advent of the internet, and again, since then you've seen a number of financial crises, some displacements. You've seen more social unrest. You throw a coronavirus pandemic on top of that, and again, it creates social unrest because of the uncertainty. And it's a long way of saying that this has occurred over and over again in human history, and you tend to see social unrest as you see these types of shifts in the supply and demand curve for labor, because that's what really impacts most of us day to day. So price floors in a labor market. So there's a lot of talk around minimum wage and other things. So salaries or wages, as a definition, is money paid for work or service. The minimum wage is a price floor that makes it illegal for an employer to pay employees less than a certain hourly rate. So if the minimum wage is $15.74 an hour, then an employer can't pay less than $15.74 an hour, even if the worker is willing to accept it. And then there's also a definition of a living wage, which is the amount a full-time worker would need to afford the essentials of life: food, clothing, shelter, and healthcare. And again, there's always questions around, well, what level of healthcare, what level of shelter, what level of food, what level of clothing? Does that mean that they should be able to eat out sometimes? Does that mean that they should be able to get elective healthcare procedures? Does that mean that they should be able to live, on their own, or does shelter mean, with other people in a shared apartment type environment? So there's still definitions within definitions that need to be sorted out. But for the purpose of this, where we're not getting into that level of policy, let's talk living wages, the amount a full-time worker would need to afford food, clothing, shelter, and basic health care. So here's a living example, or here's an example of a living wage for a price floor. The original equilibrium in the labor market was $10, and that was 1,200 workers. That's shown here. Imposing a wage floor, so essentially putting a minimum wage in at $12 an hour, leads to an excess supply of labor because you've got more people willing to work, 1,600 workers. However, you've got only 700 workers demanded, which is then going to create a 900 person, essentially, unemployment pool. Because only 700 people are going to be employed at the $12 an hour, but you've got 1,600 people who are willing to work, which creates an excess supply of labor. You're going to have 900 people essentially showing as unemployed. The same factors for supply and demand occur in financial markets as well. Savings is a supply of financial capital. Borrowing is a demand for financial capital. And financial capital is economic resources measured in terms of money. So when we talk about financial capital, we mean money. Interest rates is a price of borrowing in the financial market. It's a rate of return on an investment. It's a rate of return that you're requiring as an investor for both the risk you're undertaking as well as a risk-free rate. And when you take Principles of Finance course, you're going to get an entire section on how to calculate the risk premium and risk-free rate. But those are the components that go into the interest rate. And then you've got usury laws, which is more of a policy issue, which is laws that impose an upper limit on the amount of interest that a lender can charge to a borrower. And there's ways that people work around it with loan fees and other things, and that's your payday lending environment. But on balance, usury laws are laws that impose an upper limit on interest rates. So let's look at the supply and demand for borrowing money with credit cards. So here you've got interest rates on this axis, and then you've got billions of dollars borrowed on this. So at the equilibrium 15% interest rate, you're going to see $600 billion borrowed on credit cards. At a below equilibrium interest rate of 13%, the credit card companies are going to be willing to supply less credit because they're not being compensated as much for things like credit losses, etc. Where up here, you may see folks excited about the opportunity to borrow more money at a lower price because, again, going to Principles of Finance approach, their projects are going to be able to return them higher than 13%, so they're going to be able to get a return in excess of the borrowing cost. So they may want $700 million, but there's only going to be $500 million supplied. At the top here at 21%, there is plenty of credit available, but folks aren't going to borrow as much because, again, projects. are not going to get the same level of return. So supply and demand for borrowing money with credit cards. In this market for credit card borrowing, we talked through this. The demand curve for borrowing financial capital and supply curve for lending financial capital has the equilibrium here at 600. At the equilibrium price, at 15%, the quantity of financial capital being loaned is 600 billion. At an above equilibrium interest rate like 21%, the quantity of financial capital would increase to 750. The quantity demanded would decrease to 480. On the below equilibrium interest rate, where you've got an interest rate ceiling, for instance, the quantity of financial capital would increase to 700 billion, but the supplied or the demanded, but the quantity supplied would fall. And in this particular case, what you could end up having happen is a black market for borrowed money, because you don't have enough in the legitimate market to lend at that rate below, that's set at below equilibrium. And so there'll be black marketeers will come in and say, I will let you borrow money at 18%, at 21%, but it's not, it's black market, it's illegal, as opposed to in a normal market clearing environment. The original intersection of demand and supply occurs at E. A price ceiling, so again, we just talked about that, is set at the interest rate RC, which is below the equilibrium interest rate. And so the equilibrium, or so interest can adjust up to the equilibrium. As a result, there's a shortage of capital available to borrow. So financial decisions across time, you've got intertemporal decision making, which is deciding when to consume goods, now or later. And what are some examples of intertemporal decision making? I'll give one, which is kind of germane to most of us, which is saving for retirement. Do you save money now for retirement to consume goods later? Or do you consume the goods now and kind of say, I'll figure it out later when I get to retirement? And that's like a typical intertemporal decision that all of us are making anytime we have a choice to contribute to an IRA or sign up for our 401k at work. So what's the effect of growing U.S. debt? The graph shows demand for financial capital and supply of financial capital into the U.S. financial markets by the foreign sector before the increase in uncertainty regarding U.S. public debt. As you are probably aware, and I'm recording this, which is in August of 2023, U.S. public debt has now been downgraded from AAA to AA plus, which is kind of showing that we're reaching a point at which taking on additional U.S. sovereign debt is going to decrease the creditworthiness of the United States. So that original equilibrium, and that increases uncertainty. So this is germane to the current day. So the original equilibrium interest rate occurs at an equilibrium rate of R0, which is at Q0, R0, E0. The effect of growing U.S. debt, when the enthusiasm of foreign investors for investing their money in the U.S. economy diminishes, the supply of financial capital shifts to the left. So when they say, hey, we're not as comfortable with U.S. debt because there's uncertainty around repayment, could be, Congress is arguing around a shutdown or the debt ceiling, or debt volumes just get too high, you see a shift in the capital supplied to the left. And as a result, that leads to a new equilibrium E, where the quantity supplied is lower and the interest rate is higher, which could then cause another issue where the U.S. can't borrow enough, which causes a need to raise interest rates again, because demand goes up. And so as a result, you end up with demand that may be up here, and now all of a sudden to get back to the quantity you need at Q0, the demand intersects at a significantly higher interest rate, which will cause interest rates to rise. And you can see some of that in the current markets today. So is a market system an efficient mechanism for information? Well, supply and demand models are the really second fundamental diagram for this course. So first one is kind of looking at budget constraints and opportunity set, and whether you're kind of within or without the production possibility frontier, or within or without the budget that's set. The second is supply and demand. At what price are goods and services traded? Supply and demand curves explain existing levels of and how economic events will cause changes in prices and quantities. Again, in a world of scarcity, when you can't have everything you want, there's trade-offs, and really that trade-off is measured in terms of price. The horizontal axis shows the different measures of quantity of a good or service, labor for a given job, financial capital, and the vertical axis shows price. So horizontal shows quantity, vertical shows price. The price of a good or service, a wage in a labor market, the rate of return like interest rates in the financial markets. So the effect of price controls, where you say, you can't charge more than X% interest, or you must pay a minimum wage of Y. Changes in demand and supply reveal themselves through customer and producer behavior. Price controls may deprive everyone in the economy of that critical information. We don't necessarily know today in the state of Washington, for instance, what the equilibrium hourly wage might be, because we have an artificial price floor on labor of $15.74 an hour. We may not know in the state of Washington what the equilibrium point for interest rates are, because we have usury laws with a price ceiling of 24.99% interest. And so without that information, it becomes difficult for buyers and sellers to react as changes occur throughout the economy. Again, those are two examples. Usury tends not to be as much of an issue. However, on the labor side, there's a strong argument to be made that youth unemployment has gone up as a result of increasing minimum wages. Now, again, depending on what labor market you're in, there's still labor shortages, in which case, that's not the case. But you get outside of some of the major cities, and that could be a significant concern. So the generic demand and supply curve, or I like to call it a supply and demand curve. The book calls it demand and supply. I call it supply and demand because that reminds me that supply is on the top, demand is on the bottom, and when we draw the X, which is really how a supply and demand curve is drawn, supply, demand, and it's just easier for me to remember that way. So as we mentioned, the horizontal axis shows differences in measures of quantity. The vertical axis shows price. So demand for nurses, as baby boomers come of age in 2020, the median salary for nurses was $75,330. As the demand for services increases because baby boomers are starting to age out, they're requiring additional care, additional medical costs, or moving into nursing homes and other skilled nursing facilities. The demand curve shifts to the right from D0 to D1, and the equilibrium quantity of nurses increases from QE0 to QE1. So what happens is there's an increased demand for nurses. The quantity of nurses increases because more folks start to make nursing a career when they see that the equilibrium salary has gone up from $75,330 into the 80s. And they're like, okay, well, it makes sense to go be a nurse. I can make good money being a nurse. And so as a result, the equilibrium supply and equilibrium price change. What happened, however, was those same baby boomers were the nurses. So you ended up with both a shift in demand as baby boomers began to age, and you saw a decrease in supply as baby boomers began to retire. So you saw kind of a perfect storm in nursing where demand increased and supply fell. So what happened? Well, you now have kind of this, we've talked about it kind of a manifold change in supply and demand. You see demand increases, so you now have a new equilibrium price point at E1 at a new salary of PE1 and a QE1. However, because you have baby boomers retiring or getting sick, etc., you see supply of nurses as they leave the workforce, as the baby boomers leave the workforce, decline. So now the supply shifts leftward, and as a result, you have now fewer nurses than you need, and you've got to pay even more. So nursing salaries in some cases have gone from $75,000 to nearly $100,000 because of this dynamic in the labor market, where you have an increase in demand due to aging baby boomers and you have a decrease in supply due to aging baby boomers. So that's a little bit about labor and financial markets. Again, they underpin a lot of economic thought and a lot of economic policy decision making, and we'll dig into that more as we go through the course.